Have you ever looked at the headlines and wondered how some people making millions or even billions of dollars a year can legally pay next to nothing in taxes? Well, today we're going to pull back the curtain on the US tax code. We're going to see how it's not just a system for collecting money, but actually a powerful roadmap for building real wealth.
So that really is the big question, isn't it? How is that even possible? I know, it sounds almost unbelievable, but it's totally true. And the secret isn't some shady back alley scheme. Nope, it's written directly into the tax code itself, available for literally anyone to use.
And this right here is the fundamental shift in thinking you need to make. Forget the word loopholes. The wealthy don't really see loopholes, they see a system of carefully designed incentives. See, the government actually wants you to do certain things, and it uses the tax code to reward you for it.
Okay, so let's get right to the heart of this. The tax code isn't just some big, complicated book of rules you have to follow. It's more like a guide to what the government values and wants to see more of in the economy. And understanding this is the absolute first step to changing your entire financial picture. You know, what's so interesting is how simple this core idea really is. According to experts, the government would much rather motivate private citizens with tax breaks than have to go out and do everything itself. It's basically a partnership, and these tax benefits, they're your invitation to join. So, what exactly does the government want you to do? Well, the code really prioritizes these three key areas. It wants people to provide housing, so it doesn't have to build it. It wants people to create jobs by starting and running businesses. And it wants people to fuel the economy by taking on investment risks. If you do any of these things, the tax code is designed to reward you heavily. So, with those incentives in mind, let's look at the first major tool for partnering with the government: real estate. And honestly, it's arguably the most powerful way to do this because providing housing is such a high priority. And that means the tax benefits here are just massive. This brings us to the absolute superstar of real estate tax benefits, depreciation. It's a funny word, but here's what it means. The government lets you deduct the cost of a building over time, based on the idea that it's wearing out. But the truly brilliant part is you get this huge tax deduction on paper, even while your property is likely going up in actual market value. It's a loss on your tax return that isn't a loss in your bank account. And here's where the scale of this just becomes mind-blowing. Let's say you buy a property where the building itself is valued at $1 million. The government allows you to eventually take a $1 million tax deduction for that. Yeah, you get to write off the entire cost of the structure while you're collecting rent, and the asset is appreciating. It's incredible. But, savvy investors don't want to wait nearly 28 years to get all those savings. So, the tax code offers a way to speed things up. A lot. Instead of taking these little deductions every single year, you can actually front load them, getting a much bigger tax break in the first few years you own the property. So, how do you do that legally? It's done through something called a cost segregation study. This is where engineers literally go through a property and separate all its little components, like the carpets, the lights, the appliances, from the main building. All those smaller pieces have a shorter useful life, so the tax code lets you depreciate them way faster, sometimes in just 5 to 7 years. And that unlocks huge tax savings for you right away. Now, here's the crucial part: connecting these massive paper losses to your other income. For a lot of high-income earners, there are basically two main paths. You can either qualify as a real estate professional, which, fair warning, takes a ton of time, or a much more common path is the short-term rental strategy. If your average guest stays for less than 7 days and you're actively involved in managing the property, the tax code often lets you use those real estate losses to directly slash the tax you owe on your main W-2 job income. Okay, moving on from real estate, the second powerhouse tool for tax savings is owning a business. The government loves business owners, and why wouldn't they? They create jobs, they drive the economy, so to encourage this, the tax code is structured to give them a pretty significant edge over traditional employees.
The magic here often kicks off with what's called a pass-through structure, like an LLC. It just means the business itself doesn't pay income tax. Instead, all the profits and losses pass through directly to you, the owner. This is so key because it helps you avoid that dreaded double taxation that big corporations face. You know, where the company gets taxed and then the shareholders get taxed again on their dividends.
But listen, just having an LLC isn't an automatic win. You have to use it the right way. Some of the most common mistakes people make are mixing personal and business funds, which can totally destroy your legal protection, and failing to change your structure as your business gets more and more profitable. Trust me, these mistakes can be incredibly costly.
And this is where things get really interesting, because there's a clear tipping point. Once your business profit starts hitting around $50,000 a year, that 15.3% self-employment tax on every single dollar becomes a huge burden. By choosing to be taxed as an S-corp, you can pay yourself a reasonable salary, which the IRS says has to be in line with your industry, and then take the rest of your profit as a distribution, which isn't subject to that tax. This one move can literally save you thousands.
All right, let's zoom out and connect all of these tools to the ultimate goal, building generational wealth. Because these strategies aren't just about saving a few bucks on your taxes this year. No, they're the fundamental building blocks for creating and, just as importantly, preserving wealth for generations to come.
The key takeaway here is that this is a long-term game. By using these tax advantage tools, real estate and business ownership, you're not just lowering your tax bill, you're actively converting your high-taxed earned income into appreciating assets. And the tax code has one final incredible gift for when you eventually pass those assets on.
And this is it. It's called the step-up in basis. And in simple terms, what it means is when you pass away and leave an asset, like a rental property or a stock portfolio to your kids or your heirs, the price you originally paid for it is basically forgotten. The asset's new cost for tax purposes becomes whatever its fair market value was on the day you died. This is where the true power of this provision just becomes crystal clear. Imagine you used those strategies we talked about to buy a property for $200,000, and it's worth $2 million when you pass it on. That entire $1.8 million in capital gains, poof, it's legally completely erased. Your kids inherit that property with a $2 million basis, and they owe zero capital gains tax on all that growth. It is the single most powerful tool for transferring wealth in the entire tax code. So when you stop seeing the tax code as a burden and start seeing it for what it is, a set of incentives, a partnership to build housing, create jobs, and invest, you realize it's a roadmap. The path to building significant, lasting wealth is laid out right there in black and white. The only question left is, will you follow it?